Live, best timing yet. A lot happened over the weekend for the world and markets. A new invasion or war began, unfortunately, for people around the world. Prayers for everybody involved. It's tough to see. You want to cover how that's affecting the market and that subject?
Yeah. Hold on. I have to post this one. Well, I'll do it after when you're next speaking. Yeah. So basically, what I was seeing is, especially I think with the reaction to the 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 non-government shutdown, you might say, I would say that the market has been responding pretty well to difficult news. I would say, like especially in tech, that we've seen a pretty strong resilience, support, you might call it. But I've been pretty encouraged by that, to be honest. And we see the QQQ net option sentiment staying pretty high and the SPY net option sentiment staying low, which was the typical behavior for a lot of last year, by the way. We've only seen some recent changes in those numbers getting closer together. So to me, what we continually see and what we saw yesterday is we definitely saw the market getting worried, more people kind of hedging with SPY, put options. That's how net option sentiment would actually stay lower for SPY than QQQ. And yeah, we talked about it in our letter. We still like big tech in these situations. Anything touching AI, I think we're going to get to that topic a little later in the session. But yeah, we are definitely seeing some positive market dynamics, I would say, in terms of the price support at these levels, especially for tech. And you're seeing that reflected in ongoing bullishness in the especially QQQ options markets. Even with difficult news stories. So that's the positive. I think we're going to get into some, more specific offshoots. So I'll let you tackle that yourself.
Yeah, so there's a lot of repercussions from what's going on. So I think we saw in some of the signals that we had that defense stocks kind of got boosted from the news that we got over the weekend. And if you could kind of give which one you like the best or what you're seeing in that sector.
Yeah, I was very close to adding General Dynamics to the newsletter, but actually part of what stopped me is we haven't figured out good ways to deal with like live news events, and I might have had to wake up at 4 a.m. to just like put it in the portfolio. But we're gonna have to figure out a way to do that because I did almost buy General Dynamics, and basically what I did, and Prospero is actually building systems to do this better. But we are essentially looking to get stocks in by organizing around frameworks. Like someday in Prospero, you'll be able to Google like defense stocks or stocks that will go up when Israel or when there's attack in the middle, when there's an attack in the Middle East or something like that. But it would form to the language. We have a lot of plans how we're going to build our back end like that. But yeah, I would say that General Dynamics is one, Northrop Grumman is one that we also like almost as much. But General Dynamics, the reason I'm singling that out is it actually had high net option sentiment before the news about Israel broke. So I think that that's an important thing and always what I look for, and it's helpful if you want to look at the time series graphs. I always think the things that are going to be more sustainable in these news-based stories are ones that have good metrics before the actual news breaks. So yeah, I would say that that's a definite thing that I look for and why I was going to lean towards General Dynamics or Northrop Grumman. I will say, Raytheon, for example, is something that's hot. It's very hot in social sentiment, but downside breakout is actually higher than upside breakout in Prospero, which is why we, despite the high social sentiment, it's like the opposite of what we're saying. Like that might be a pure social rally, whereas getting involved in Northrop Grumman or General Dynamics around this news story is going to be a more sustainable play, in our opinion.
Interesting. And it seems like a lot of investors nowadays, they kind of get bored by, the defense sector and the next sector we're going to talk about, which is the oil giants and the oil sector, which kind of oil has been raised. It was kind of going up before this event even happened. And since it seems to have boosted a bit. And I wanted to get your opinion on if you find any of the oil giants interesting or if they're just, shelve companies, now that they're kind of past their peaks?
What is tough about the oil giants, I would say, is that they are, a news like this is great for them. And obviously you could say, oh, oil prices go up, oil giants do well. And they're kind of tied to that. The big problem that I have with these stocks overall is that you have something like OPEC, you have something that is like in such control over the supply of something that that can actually change the dynamics in a second. OPEC could decide that prices are great. They want to dump some more in the market, make some more money because they're trying to finance, war for various. I'm not going to get into the specifics of that. But for a variety of reasons, they could want to put more supply into the market, which obviously affects the price. And to me, that's what makes it really tough when you have like an external force. And we talk about some of the same things that we talk about China that can really affect things. Something that I'm kicking myself a little more for not keeping in the portfolio because, we're trying to do it in more system where we're a little more organized with our newsletter picks and we do the filters and CEIX is one that I had in last week that I just barely, lost because it was lower in the filter. It went down to 45 and we've been trying to stay really, into that. But overall, this kind of event makes all kind of energy look more attractive. And I'll tie the string for you, right? Oil becomes more expensive. All of a sudden, something like coal or any alternatives become more attractive the more expensive oil is. So that's something that where all the tides can rise. And CEIX is a coal company and not something that you would think of traditionally that would do well because oil in a vacuum. But the nice thing and why I'm tying CEIX as a preferred play to this event is that you can actually get some of the same benefits of oil prices rising without the same risks of those prices going down and those really and that really like immediately hurting the oil stocks. Obviously what we're talking about is there is a consistent tie here between rising prices and making alternatives most attractive, and that can happen in reverse. But I think what you get with and especially as a retail trader, this is important, you get a little more time. Like oil prices to oil stocks are pretty instantaneous, but you could say be tracking oil stocks and not necessarily have as quick of an impact on your coal plays or as big of an impact on your coal plays, which is why and coal is not the only thing. Obviously there's a lot of other interconnections and things like alternatives or EVs. I think also can do very well when you have kind of extended oil price rises, obviously. But yeah, I think all of that is like just really important to consider, these surrounding circumstances. And also just like, it is just really tough, especially when a bunch of people are charging into something like oil because everybody had the same idea as you to be confident that you really have the right angle on it. And I think that that's the big thing. And again, like the thing that I always like to tie people back to, especially with like high frequency traders and everything, is like if you're going to make a play that is so tied to something like the price of oil, the algorithms are going to embed that into what they're doing much faster than you ever can. So you're going to be constantly behind their, like you might call it, price arbitrage opportunities. But that is just not as true with other things. So I think that that's why I don't really like to play oil like one way or the other. Oil prices is just like a whole other forecast. And what we will do in our larger portfolio, our model portfolio, is if we see any kind of energy stock with the kind of dynamics that we like, rising net option sentiment, rising upside breakout, or for a short kind of the opposite, and then rising downside breakout, we prefer to have that in a larger portfolio, make those plays in a diversified setting. But when we're talking about a smaller portfolio or a newsletter, like we talk about those as higher conviction things. And I'm talking about something like 10, maybe 15 is the largest the model portfolio gets, the largest the newsletter picks get for the investing letter. But the model portfolio for the trading letter, it hit even 80 stocks last week. So we're talking about much more diversification. So we have to touch the whole market, but it's not as high conviction and why we make that distinction is like I can wrap my head around, I think, all of the forces that, could strongly affect tech prices, or even deeper. Obviously, AI is something that I like to lean into because I have a lot of expertise in that. And that's what anyone should always do, lean into their areas of expertise. But oil is its own game. And even the people that know it really well and spend their life in it, they still don't necessarily know what OPEC is going to do all the time. And that is such a large controller of oil. But obviously, everything that I'm saying is, you study OPEC for a while and your game is oil. And yeah, you probably can get some kind of inclination into how these react to those, how they might react to those situations. But I kind of look at it like this. Even like in this country in tech, I have people that work in tech. I know people that work in AI. I have sources there. So like I am also closer to, what you might call the objective truth about these companies. And even if, you are an American analyzer of these companies, you don't necessarily have sources in OPEC. You might, but you're probably not as close to them unless you maybe have citizenship in OPEC countries. Maybe you do a lot of business. But the point is, even then, I just don't feel like you're as on the inside as someone that is just, living in that country and has, closer access to that information. And I think that's a real uphill battle as a result.
Hmm. Yeah, and so the last kind of talking point I wanted to bring up before we move on from this subject is, does everything that's going on now kind of change the Fed's path over the next 6 months? Because Jerome Powell just kind of sounded hawkish and he was leaving the door open for raising rates one more time. And seems like a lot of kind of bearish stuff going on in the world. So do you think this could affect the Fed's path?
Yeah, I mean, I think we've talked about this. I think Powell is going to react to one of two things. He's going to, if the job market continues to stay, more robust and have more support in terms of the downside than we've seen than might be expected. If inflation like lingers a little longer, then he's definitely, if the stock market performs well, he's definitely going to take his time and be more conservative in terms of how much he's raising rates, how much he's handling that situation, etc. On the other hand, we also talk about like the floor and him starting to cut rates faster if he kind of sees behavior like the market going way down or this conflict escalating and him needing to reassure everybody that the market had support in terms of perhaps no more rate increases, closer cuts. So I think that's what we kind of like. There is a theme and it's consistent, and this is kind of like where I'm at with anything that isn't kind of like catastrophic, which is like something that we more talk about in like Taiwan being attacked and having like such a close connection with chip. I would call that more on the catastrophe scale in terms of our reliance on that chip manufacturing and how it affects like AI and supplying NVIDIA, all that stuff. But I would say other than that, like this isn't necessarily a small event, but it would only like impact Powell in the sense of if he saw really difficult adversarial market conditions that he doesn't want to spiral out of control, then I think he would step in. And the last thing to say on it is like, does this get us closer to that kind of bear market? I would say absolutely. Like something that is a really adverse bear market that could really have people change from it. But yes, I think that that is a really important part of it. And if the market is really affected, I think that's definitely something that needs to be adjusted. I may have just I realized I sent out a calendar invite for this, and I may have added people to the stage. I'm sorry if anyone had difficulty getting in. I might have sent the wrong link to my calendar invites. I will get that right. I actually just saw my mom pop into the studio. Probably does not want to be on stage. But
we're gonna have some guest people with us today. It looks like.
Oh, she's there. I see her. I see her backstage there. A loyal watcher,
pass.
a loyal watcher of the live streams.
Mm-hmm. That's funny. I saw her pop up too. Okay, so it was funny how you mentioned before that with oil prices that the algorithms could trade faster than you would ever like be able to react to, because that's actually something I wanted to ask you about last Friday. The second the jobs report came in and it was twice as hot as it was expected, the market dropped like a percent, like within minutes. I mean, instantly it seemed bearish. And then the rest of the day, the market ripped. It just went bullish for like the entire rest of the day. So a couple thoughts on that, like were the algorithms wrong because they reacted so bad and then it turned out to be bullish? And just like why does that happen? Like is it pre-market, not a lot of activity, so it's able to move so quickly? And just kind of just explaining that whole situation.
Yeah, there's so many interesting forces at play, I would say, right now. And we basically saw, well, on Wednesday, ADP actually reported some weaker numbers and they missed below on their expectations. And we actually saw the market respond well to that because of basically one of the things that we've talked about here, which is that the market feels that we're only going to get rate cuts when there's a certain amount of problems in the job market. So they saw the problems and that actually rallied the market. So I think on Friday, what we might have just seen was an initial readjustment to that, where it's like, oh, actually, like this job problems that we saw actually don't look as problematic when we have this, other kind of jobs reading. And one is payrolls, obviously, and one is more directly to the actual job market. So those can be very different for a variety of reasons. Especially because there could be salary adjustments in there that don't result in job losses, just like one example. Or don't, you could also like have more job openings because you're cutting salary, which is, might be a more logical explanation for what we just saw. So, that is something that I think is really important. And I think that something that we've seen and is like a troubling sign, and we've like talked about it in terms of Lyft and Uber. But I've actually recently been watching some. And I didn't know about her, Katie Porter. I always like my Bernie Sanders clips, more than anything, especially him being on the right side of things for like a very long time in terms of some issues. But like, yeah, I think some of these things that make a lot of sense, that what she drives on is that it's just like she's questioned like Wells Fargo and said like, why do a third of your employees need support on in terms of government support for your jobs, for your basically lower level jobs? And she asked Jamie Dimon a very similar question. And I think I'm talking about it within the scope of that because that's a trend that I really don't like to see. And we talked about it in relation to like, tipping and the job market in a previous live stream. But it's like, no, it's really kind of wrong that we're seeing more and more of the salaries getting lowered to like such an extent, even as the cost of living is raising. And, we talk about people having more credit card debt. So, it's less, relative spending that people have. But that's really the shame of it when we see readings like that, where like payrolls can be down and actual like job openings can be up. It's just kind of like a larger sign that we're seeing more of this transition. And that's a big shame. Back to your original question in terms of like the Friday market. I think we're seeing some of that in terms of like a recorrection of like, oh, maybe like, maybe the job, like the hurt in jobs we overreacted to, and we're not going to get, we're not going to have that tie to cutting rates sooner. We might have seen some of that. But, the other thing you might call like what you drew attention to, like uncertainty moving in one direction and the other. I think that's just because like it was also a little confusing. Like we talk about this as being like something where it's just like, oh, like, well, job troubles, now we're going to get rate cuts sooner. But it's like job troubles are also job troubles, and they're also like impacting the economy. And traditionally, when there's job troubles not so closely tied to these desire to cut rates, that's not a good thing. The stock market does not react positively generally to a declining jobs market. So that's just like an interesting, like, different forces kind of pushing and pulling at each other, where we're basically seeing, essentially indecision in the market. Because but on the one hand, a tougher jobs market is absolutely going to get us on a path to getting rate cuts sooner. But on the other hand, it's not a good sign for the economy and like some of the spending things that we're concerned about in terms of like consumer spending. Wish is something that we own. Like we are like Cracker Barrel and Wish are two companies that we've held on to for a few weeks because they're consumer cyclical sector. And we think that that's a lot of what's going to be hurt by this, like less payroll, even if there's more jobs, less spending on those types of goods. But yeah, I think that like when we see that, yes, like part of it is indecision, and part of what you're seeing is like algorithms kind of leaving the way, trying one momentum shift, trying the other. Because like nobody, like people don't necessarily know how to like work out how this works. So sometimes, especially at how these large funds like are making decisions, sometimes they're actually watching how like the high frequency traders, how the short term trading machines let it play out before they even decide how they want to play it on their end. So I think that's probably the behavior that you're seeing. You see kind of the machine battles in the morning over the news, and then the people deciding like, oh, well, that wasn't as bad as I thought. I'm ready to take some more long positions. And I think that's the kind of behavior that you see with this back and forth that doesn't make sense, because it doesn't really necessarily make sense to the machines either. And they're basically just playing some like live signaling games with the other machines to figure out like what, the market wants.
Hmm. Yeah, that's all really interesting stuff to me like see behind the scenes and hear from you like how the underpinnings of the market are working. Um, but one thing I wanted to ask you about that is, would we have seen, in your opinion, like a continuation of Friday if we hadn't gotten that big news event over the weekend?
Oh yeah. I mean, we are seeing that a little bit today. What's going on with the QQQ? It's been a little up and down. Yeah, it's down more since I last checked. Yeah, I do. I do think we would have gotten that for sure. Like we saw, especially in the SPY net option sentiment, like we saw it like slip into our bull zone, and you can probably pull this up from our newsletter to end the week in a pretty solid, like straight line fashion. And the QQQ was already sitting in the bull zone. So yeah, I think this would have been a nice little like bull reversal to the recent bear run that we've seen if that didn't happen. But and we still might. It remains to be seen. Like we kind of had an underwhelming day for the shutdown. It started worse and then got a lot better. So we might see similar behavior. Because this is the kind of thing where we talk about how expected something is all the time, and like in terms of like modeling, like it is not a bad thing to have in your model. Like maybe not specifically, but like what happens if there's tensions in the Middle East? Because there's been tensions in the Middle East a lot, et cetera, et cetera. You know how to model that. You know how to model it on oil. You know how to model, coal, blah, blah, et cetera. Like that is a known problem with known data sets. So it's easy for you to model those things in, react to them. It's not like as big of like a catastrophic event or what have you. So I think that's part of this, where it's just like, okay, the models work in their new assumptions into like, higher, special energy, et cetera, higher defense, some other stocks are going to get hurt on the other side of that. In terms of just like general worry, general instability. Or, you could even look at it like, someone selling part of their tech portfolio, a hedge fund selling part of their tech portfolio to buy more energy, to buy more defense. So I think you have to look at it like dollars like that sometimes, where if something's going to go up, sometimes something has to go down, because especially with interest rates high, they're not necessarily moving more money into the equity markets, allocating more than they already will, which could, by the way, be a way this gets solved in lower interest rate margin, lower interest rate lower interest rate markets, where they just say, hey, we wanted bonds, we still like our tech portfolio, we're going to move more dollars into defense, into energy, and they don't have to sell their other positions to do that. I do think it's more likely in this interest rate environment that that's what we're seeing, with other stocks kind of taking a bit of a bath today. Well, not a bath, like you might call it a light bath, a lukewarm one. But like, yeah, I do think that like the difference between that and like an event like we talk about, like catastrophic, like Taiwan, like there are no models that tell people what would happen if Taiwan was attacked. So all that's going to happen there is that everybody's going to panic because they don't know. And when people don't have modeling answers, they just assume the worst, because that's like conservative modeling. And we talk about that all the time. So yeah, I think that's the main difference, is that it's just like, okay, sell some other stocks, buy some defense, buy some energy, and the markets go on, and maybe they even recover from that. People take their quick 10% gain on Northrop Grumman, and then they're like, all right, now I'm grabbing that, I'm following that back into tech that is 2% lower than when I sold it to like make this swing trade. So you never know like how quickly it's going to work out. But I do think that's the important thing, like for these known problems. And it sucks to be able to say like, oh, like, Israel at war with Palestine or Hamas or Hezbollah or like however, I don't even want to get like bogged down in how complicated that issue is. But I will say that unfortunately, that's a known problem. Unfortunately, people know how the markets react to that because it has happened enough times that people just like, they know the playbook.
So after, being so bullish to start the year, then flipping bearish kind of August, September, how would you consider yourself like right now? More neutral or still bearish? Can we get a bullish George back?
No, I don't think he's coming back for the rest of the year. Not until we hear some like tangible talk of like when rates are actually going to be cut. But I will say like, I'm generally like the reason I did like my 4 bulls and 4 bears in the newsletter is like, I'm generally bearish, which is why like even last week I got a little more bullish. I had 5 bulls and 4 bears. And that worked out better. But yeah, I think that essentially I can only get so bullish because of what we're talking about. I do feel like there's a ceiling on the market. Whereas like if we do have a nice little bull run, like I think we're almost definitely going to get another rate raise, maybe even 2 if things are really solid. So it's just like there's unfortunately a cap on how well the market can do because Powell has basically like shown that he's going to use whatever space he has. If he has a solid market, he's going to use that space to like raise rates more. We know that. We have data on that. Like we talk about this all the time. Like people were basically saying we would have to start cutting rates like by the end of this year, beginning of next, to have any shot of a like non-extended bear run. But we've had some nice bull runs without that. And what happens? Like Powell takes that space to increase rates more. So the biggest, I think, lesson that I think is so important, like people say all the time, past performance doesn't reflect future results. And that's super important, especially as it relates to stocks. And I think as it relates to stocks, it's good to keep yourself honest, especially a stock that just like keeps going up and up and up. You want to assume that it's going to happen forever, but stocks have a certain value that they just are not attractive at anymore. And you always have to be mindful of that. But I would say that doesn't hold as true for like economic data and things like that. That's going to kind of be a little more conservative. And like past performance can be more of a reflection on future results when it comes to like market doing well, Powell expectations around interest rates change as the market does well. He gets a little more hawkish in terms of how much he's going to raise rates. We have data on that, pretty consistent data this year. There's absolutely no reason he's going to expect to change that tune, especially when he's talking as if he hasn't changed that tune.
Yeah, I hear you there. And we got a comment from Wolf Sigma. Congrats on improving audio. Thank you. We're upping the quality of the streams, the camera, the audio, looking better these days. But now it's time to get into our stock talking points of the day. So our first one, we have to give kudos to George because he was the one talking about Google AI and how they're not actually behind. When everybody said they're going to be crushed by ChatGPT and Microsoft, they released something today where they're going to allow doctors and nurses to aggregate medical data onto one platform, whereas now they have to search like through many different places and it's time consuming. So it's interesting because people said AI was going to crush Google search, but this is actually them using AI to help search. So you want to speak on that?
Yeah, I think there's like so many interesting things to say about that. But one of the things that I always compliment Google on in terms of AI, and I think it's a big difference and actually just like very important as to why they could get a deal like this or like set it up, is that Google at the end of the day is just more of a science company. Like when they acquired DeepMind, like DeepMind didn't necessarily want to sell to anyone. Like Google has proven DNA, R&D, science, putting like that kind of science first as an organization. And it's very different than Microsoft. Microsoft is much more corporate, much more like squeezing as much money out of products as they can. Like they're very like, if you look at like Windows, like they're not necessarily big on improving it. They're big on like ingraining themselves more in a business sense. And that's not really a scientific approach. A scientific approach is more like, let's get the best product with the best features out there. And like, that's how we're going to spend our money versus like on relationship. Like one of the best examples of this is like, there was a big government contract that I think either Amazon or Google were supposed to get, like their cloud. And Azure like swooped in, and even though everybody said it was a less good product, everybody was like, yeah, like Microsoft was greasing the wheels. They were making the right deals, shaking the right hands. And like that's a big difference between like a science-driven company and a business-driven company. And I transitioned to that because if you look at what's happening in like a medical deal, like what are those medical practices care about that are giving permission to like share this data, letting Google in? They care more that they're dealing with scientists and that it's going to be used for science, and that, you know, a product around that and product quality and delivery to the other end is the priority. I feel like too often with Microsoft, the product is the afterthought to the business. And I think that's what happens when you get a like really business product driven company versus like a science driven company. And when you're talking about something like AI, like you always need to be on the cutting edge of science. And I just trust Google more to do that because better scientists want to work at a place where science is more of a priority. So you're going to be able to recruit better that way. And, you know, it's just very hard on a longer scale with something like AI to bet against a company that fosters science more than a company like Microsoft that fosters it less.
Yeah, for our watchers, not with Google, but the CEO of OpenAI, Sam Altman, I believe his name is. He was just on Joe Rogan, and it's a big. I didn't watch the podcast yet, but he always says interesting stuff. He's done a few podcasts, and it's actually crazy because even though he's the CEO of OpenAI, like the leading AI company, he's very realistic about the dangers of AI, and he talks about like how it needs to be handled carefully. And George, someone as like you who's so into AI, I'm sure you probably have the same opinion as him, how it needs to be like dealt with very carefully going forward.
Yeah, I probably I wouldn't be surprised if he had a similar view. This is just like his public view on it. But my view is that we've crossed a threshold where like AI is going to be like, I'd say within 10 years, like a pretty um domineering force in our society. Like, and I changed domineering because like I would say it's in the phase right now where it's involved. Like, but it isn't necessarily in charge. But like when you start to say domineering, it doesn't necessarily, I'm not saying AI is going to run governments, but I am saying like the more we depend on it and integrate, the more like, and the smarter it gets, the better it gets in its decisions, the more data we give it access to, which is happening more and more, the more its opinion, whatever you want to call it, matters. And that's why I will give it kind of a domineering, like, you know, domineering thing. And like my philosophy on it is like, there's going to be people that care about building good AI. And then there's going to be people like, you know, Microsoft that just wants to make money. And I would consider Google somewhere in between, like, you know, me and Microsoft, you know, maybe somewhere pretty closely in the middle. But I would like to make AI that's like explicitly built to help people. And that's why we're focusing on investments. And that's a great way to help people and help everyday people over institutions. Like, and I think by having goals like that, that are, you know, pretty noble, that AI can do well with that. Because AI is just something that you have to point it at a problem to solve. And, you know, there's very concerning things like, you know, killer robots. There's a really good Netflix documentary on what is it called? I think it's called Unknown, and they have some really good ones. But one of them is on fighting robots, and I'd really recommend it. Um, but you have those kind of forces, and you need balancing forces for good, and that's what I'm all about. Where I'm just like, I want to build a force for good because we are past the threshold where we can stop it. We we need we definitely need like more people like that, and I see other good AI people out there, and I always try to like bring them into an extended AI circle. Um, so yeah, I think that that is really really important, um, and that there needs to be more people like me, and beyond that, if you support Prospero, you support our paid products, great. Think about doing that more, especially when it comes to AI. If you can think about like looking at the organization, seeing which ones are doing things that you like and you support with technology. Like I would say, other than us, like I would look more at like charities. But yeah, there's AI for good is one that I really like. But I would say, look, the best thing you could do as an American is vote with your dollars. That's what I always say. Like our opinions matter very little. Our dollars do really matter. So anytime you see like whether it's like technology or a cause or whatever, vote with your dollars. And that will get more of what you want and more of the vibe that you want.
So we got some really kind words from Wolf Stigma. Thank you. And it's all George. I'm just the setup man, and he's spiking the volleyball. So he gave you a compliment, George. So that should feel good. And Microsoft catching some ricochet shots today. Kind of railing on them a bit. I guess they're just too corporate, too money focused.
Yeah, I mean, there's a great like there's a history of Jobs and Gates and like how they went around and battled for like, and it's pretty brutal. Like there was a lot of idea stealing, like it's just one of those things. And but unfortunately, this is life sometimes. Like Microsoft did much better than Apple. It took some of their ideas, it played the business game better, and it took off before them. But that's obviously a very interesting story because like Apple ended up surpassing them by being like much more like designed and creative focus and having like, a different kind of leader than Gates. Um, but yeah, I would say that that's a really important part of it. And yeah, I don't really like I don't love to rail against companies just for shits and giggles, but I do think there's a practical side of it that I think people are overvaluing um, Microsoft because they made some good acquisitions, and GitHub was another really good one. They made some really good acquisitions, no doubt. But like, I just don't think they're as good as taking those and creating customer centric products. And Apple is a really good example of a customer centric product, other than their bad battery life. That's like the one exception. But there's some people that are upset about that with Apple, and there's some people that are like, yeah, whatever. I like my device. I'll buy one every year. Like, there's very different attitudes. But other than that, and like, there's a famous job story. I mean, sorry, there's a famous Bezos story that I actually like when I think about Prospero and the products that we offer. Like, I heard this, and from day one, I've gone from this. But Bezos basically had a uh, a, a customer that you would talk to in all of his early meetings. There would be an empty chair that his executives would have to talk to, and he'd be like, talk to the customer. Does the customer like this? And Amazon is one of the most customer centric, like it doesn't treat its employees that well. I don't think anyone's going to argue that, but it grew based on like offering things to the customer. Like there's a great story about like their 2-day delivery that they basically had no idea how they were going to get the logistics of that, and they just tried. And it's like one of those things that it's just like they did that to make a better experience for the customer, and they didn't even know they could do it, but they were just like, hey, we do our best, we'll get it. And I did order from them back, and they weren't always perfect with the 2-day delivery, but I was also amazed at how close to it they got. And I think that's just like by doing things that try to put the customer first, the customer can feel that. And I think that like that's a really big difference between like, I am, unfortunately, some people saw my Excel skills in the last live stream on the Discord. I got some on our Discord. I got some compliments about that. I am like an entrenched. I'm speaking from personal experience. You can't use Excel on an Apple as well. Like it's got different hotkeys, and there's very few things in the world that frustrate me as much as like using an Apple computer and like trying to use Excel, because like my fingers are trying to do things that they expect to happen and it just doesn't work, and it's very, very frustrating. That is all to say, I'm a longtime Microsoft customer, but I also kind of hate them because they don't care about my experience. And I am like here, and like if they just cared like a little more, like they're always like having these like I have to buy Microsoft Pro because it's like randomly restarting, or they roll out just like a terrible like operating system that I need to like use because like they force you to use it, and I don't really even want to, but they're just like, oh, if you want to use this new program, you have to pay like $50 to upgrade to our new operating system, and it's like a worse product. So yeah, I like can't even like I couldn't even I watched a 20-minute YouTube video on how to install Discord through their system, and I literally reinstalled Windows as a last resort, and it still didn't work. Like I ended up just like downloading it from the website, but it's just like the perfect example. Like it doesn't feel like Microsoft likes its customers. Like it just like takes them for granted. And that's why I think Apple ended up getting so many people, because that's like you use an Apple as long as it's not Excel, and you're just like, oh, a little more like this company cares about me. So like I think that that's important in terms of how you play out these like longer term forecasts, where you're just like, sure, they can make these acquisitions, but are they going to get the most out of these acquisitions? Or are they going to squeeze as much money out of these acquisitions as they can? And with Microsoft, it's almost always the latter. And that can help, like, squeezing that money, getting those short-term profits is always going to help your stock price in the short term. But in the long term, it can have bad results.
Mhm. Yeah, and you're bringing up acquisitions, and I don't even think they've closed their Activision deal yet, which feels like it's been like over a year now in the making. So I'm going to check up on that after this, see how close they are to finishing that. But
Yeah.
are you going to say something?
No, I was saying like, yeah, I think that like that's a perfect example. Like, why is it even taking so long? It's just like it seems like other companies might have given up and been like, this is too hard, but they just like that's their lifeblood. They need to acquire these new companies and like and squeeze the profits out of them because they're not good at all at inventing their own new products. Like we criticize like Google a little bit for that. Like Amazon, we obviously talk about as a really good thing. Like we say in terms of Apple that we're a little concerned about like after Jobs, how much they can create new products. But like Microsoft is terrible. I think Xbox, like people could correct me if I'm wrong, but I think Xbox was the last thing that they made. Like that was at all a good new product, like versus acquiring something. I mean, I don't know. I could be wrong. I could be missing something. And please, if you're watching and know, we like to be accurate here. And also, Wolf Stigma, thank you for the kind words. I appreciate it. You're always a very positive audience member.
Yes, thank you. We love comments. So if you have a comment, question, feel free. So here's a story about a company that everybody loves, Tesla. There was a report out of the China Passenger Car Association that showed that their sales for September in China were down 10.9%. And I saw that and I thought maybe that's kind of a big deal. I mean, a lot of their growth and the way they trade is based off growing and Tesla declining. Seems like that wouldn't react well, but then I told you and it seemed like you might have different thoughts about it.
I like that joke. Microsoft is the Borg from Star Trek. That's perfect. And you know what? I bet like the funny thing about Microsoft is I bet if you like said that to Bill Gates, he'd be like, yeah, that's a great comparison. We are very good at absorbing like large swaths of business. But anyway, yeah, I've been assimilated. I'm just like I'm like a self-hating Borg. I'm like a loyal Microsoft customer that's just like, oh God, I hate Microsoft. So that's funny. I don't know. I'm gonna have to go to therapy about that probably. But back to the original question on Tesla. Yes, I think that like one of the very interesting things, and we talk about Tesla in terms of how they're able to go direct to consumer in America, and how I have more faith in like self-driving cars getting done because of Elon Musk. But you can think about it like, they're losing market share. But, I would say, and I would say maybe a lot of other people look at it this way too, like, that's not a surprise to me. Look at other products. Like Google isn't really in China. Baidu is. Like Amazon isn't. Alibaba is. So actually, it is quite an accomplishment as an American product to break into China at all without them being like, no. So it's actually like, it says something about the products that do get into China, like Tesla, that they are that good. And there's a certain amount of being non-threatening enough to China that is part of it. Like a car is more non-threatening than say like a search engine. But at the same time, like I think, you talk about corporate espionage as it relates to China. I think having a good market share as an American company has a shelf life in China. So, I think as long as we don't see it like cascading to zero, which this announcement isn't, like it seems like a bonus to me. It seems like an accomplishment of Tesla more than a problem, because China is going to eat away at your market share. You are going to have, companies like NIO that are going to, get, preferential pricing and terms and, delivery mechanisms. So yeah, like it is something that is an expectation. It's still like maybe not great for the stock price, but I would say the fact that they got in there at all and they're holding some ground says something about how good of a product it is and its potential longevity there.
So wait, but it sounded like from what you were saying that would you expect Tesla's market share in China to just keep going down as time goes on? I guess until they hit a certain level, but just kind of.
Yeah, I would say unless they have, which I wouldn't rule it out, have some major breakthrough. I'll give an example. Like they do a lot of battery R&D, right? Let's say they come out with a new battery that is just like twice as like, charges 8 times as fast, lasts 2 times as long as let's say like NIO's battery or whatever. Those kind of advances are exactly what I'm talking about. Like some product improvements are undeniable versus the competition and they can regain. But yeah, that's what I'm saying. Like even then, the other companies in China will probably do good at copying and like, so it might ebb and flow. But once you have brand recognition in a place, I think that it is like, let's look at something here, like market share of Apple, like iPhones in China. Let's take a look.
Can I guess?
Yeah. Still
I'm
growing.
going to say 20%.
China smartphones. Yeah, it's very interesting. 20%, you're almost, wow, it does do pretty variable. It was at 22% Q4 2022 and is down to 16% Q2 2023. But it ranges from from 13 to 22% since Q1 2022. So I think that's the perfect example. Like certain versions, I would say, like certain versions of the iPhone are just like selling better, and maybe the features catch up. But it ebbs and flows, and there's brand recognition. And I would look at Tesla similarly. Like it's never going to get to a huge like segment, but I think it has enough brand recognition that people will continue to buy it in China. So I wouldn't expect it to go to zero now.
All right, flipping to our last single stock topic of the day. This story, I guess, shows that investors have no faith in the management currently at Disney because an activist investor, Nelson Peltz, announced he's taking an activist stake with his Triumph fund, and the stock actually went up based off this news. Are you surprised by that?
No, and we actually added Disney to our model portfolio at the end of last week because we started to see option sentiment, upside breakout, all of that stuff like line up for stocks that we like. So pretty proud of that, especially before a new activist. And the funny thing about like saying like activist investor at Disney, like first of all, like when you get activist attention as such like a name brand like Disney, it means you've really done some falling from grace. And I think there's like, there's there's delivery options like streaming that are a concern for Disney. And then there's fear around the parks. Obviously anything, the pandemic changed the way a lot of people looked at things, like even like movie theaters or parks or whatever. So that is like, we talk about modeling. All of a sudden, you can't just model theme park growth or even theme park stability when you say like, oh, there might be another, like as a responsible modeler, you have to like start to account for those types of things. So yeah, all that being said, there has been a certain amount of fall from grace for Disney to even get an activist investor involved. But yeah, they probably saw something like we did, is like there gets to be these worries, there get to be retail sells because they see it go down. And like we talk about, like retail trades more on emotion. If a stock goes down, like they're not like, oh, this stock is worth, $90. They're like, oh, I'm worried it's going to go to 50. And they don't necessarily like think through the actual value. But you start to get activists when someone says like, oh no, I actually think this is a $95 stock. And so I can buy it here. I can make a story around it. And not only can I change the narrative a bit on this stock, like I actually think the value of this stock is $95. So I know it's going to get there, whether or not my attempt to create a buzz and a story around it works. So you're kind of covered on both ends as an activist when you see the value and you also think your story around pitching the value is going to increase the stock price.
Yeah, and you said Disney fall from grace, and I think it's something like 10 years the stock is now negative for the past 10 years. So it's just crazy underperformance. So moving on to macro, we have some things this week. I believe we have CPI Thursday, which could lead to a terrible Friday the 13th the next day, or maybe we get flipping and it's Friday the 13th, could be bullish this year. But in any case, CPI is still going to cause the market to move in your expectation, right?
Maybe. I think we might get some of those robot fights that we're talking about, but I think unless we get a big miss one way or the other, I don't necessarily expect it. Like, and it's just because what we're talking about. At the end of the day, like, yes, some great inflation readings would certainly lower the probability that we get more hikes, like quicken the timeline that we actually get cuts. But at the same time, I think that's basically what a lot of people's expectations are. So unless we have like a big deviation from it, we're not necessarily going to see that behavior. But yeah, I think that we're probably going to get a lot of it. I think is going to have to deal with core CPI and basically like how much basically we're seeing an impact on oil. Like that is something that's like continually talked about that might have it move more or less, regardless of how much it hits or misses, like the relationship between the core and the overall. But at the same time, I think we're pretty much seeing in the market right now that it's almost more about the actual market at this point than something like inflation, where, to give you a direct example, like let's say the market has a bad few days, right? And inflation comes in right where it's supposed to. People might then, and models might then say like, oh, like the economy is going as expected. Why is there all this bearishness? And we might see a recovery. But, by the opposite, let's see if we get like a few good days leading into it and it's the exact same reading right where it is. You might have the market say like, well, this is too much enthusiasm based on the reading coming in about where it is. So I think that like that is the very interesting thing about what we're seeing. We're trying to have people controlling for too many factors where they know Powell is going to be responsive to the market. They know that, job difficulties could hurt spending, but they could also get rate cuts a little too soon. So like that is a very hard thing to work out without like, what we're basically calling like robot fights before, to see like, okay, let's see what the robots figure out before we take our position. And I think that the reason that's happening is for the reasons we always emphasize in here. A lot of like where like macro portfolio managers might have done before, a lot of that is more and more being left to robots, because you have all of these sector data points. You have all of these things like social sentiment, option sentiment, like we talk about, like, sentiment analysis on, key macro leaders, what banks are saying, etc. Like all of that is actually better suited for a machine to figure out. And that is because more and more data gets created, the harder it is for like a macro analyst to get the same readings as uh as a robot or an algorithm now. Like it's not the same thing. Like as a smart person 15, 20 years ago, you could read the Wall Street Journal. You could talk to your friends on the street that were moving the market, and you could be like, okay, like I have a good handle on, maybe you read some international news too. Okay, I feel like I have a good handle on what's happening. Now, as more and more data gets created and analyzed, like even a smart person doesn't really have the time to weigh all the factors that a computer can. So I think that's why we see these robot wars. Robot price wars.
Yes. So now we've come to the time where I'll ask people if they want to ask any questions before we're leaving. We have a few minutes left. And I'll also mention that we are now live streaming Wednesdays, 3 p.m. to 4 p.m. And last week, people seemed to love when George did his update. So if you missed it, you got to be there this week because you'll learn a lot from it. But I also want to ask you, George, while people are typing, if they're going to comment, how different do you think the prices would be of stocks if there was no robot trading or algorithm trading allowed in the market? Like if you got to watch a purely human market and one that we have now, do you think the prices would not be like similar, or would they trade like exactly the same?
I think part of what we see
Oops.
in tech, I don't think they would trade the same. I think part of what we see like in a company like Tesla, for example, is we see definitely like this social sentiment affecting algorithms, which affect institutions. And we have that whole new, I would say, kind of like workflow that wasn't created. And I think social sentiment ends up like really affecting the market a lot more because of how much it's actually proven to drive stock prices. It's a bit of a circular relationship. So I think back in the day, like profitability, value stocks, they were a lot more reliable in terms of being like stable, good gainers. But there's, I think tech speculation and algorithms working around that, sentiment and people speculating on growth stocks, I think has changed the market. And I don't think you would see like Nvidia price where it is if not for social. Like if you look at it, like we talked about, it is a big social stock. Tesla's a big social stock. They're basically trading at like more like 3 times the value of like Meta on 2024 earnings. And that is just, you can't attribute that to anything but social sentiment, buzz, excitement about the growth of those companies. And like to bring it down to like brass tacks, like look at Meta versus Tesla. I believe Meta has like an 81 profitability in Prospero and something like a 60 growth. And Tesla has I think something like a low 60s growth and a low 60s profitability and a low 70s growth. So looking at it that way, like if you add up profitability and growth, and we try to make it easy to do this, Meta is a better company. And why is it trading at a discount to its like future earnings when it is also still growing? Maybe not quite as much as Tesla, but it's still growing at a very good rate. So like I think that's a perfect example of like how can I account for the difference there? Just like social sentiment, buzz around a stock, mattering more in this environment, and mattering more because like we talk about it all the time. A stock can get hot in social sentiment, then the algorithms trade, or the algorithms trade, then it gets hot in social sentiment, then more institutions pile in, then more retail. There gets to be this like new kind of momentum, which by the way, what I really like about that is retail is more involved in that momentum than they ever have been before, because people do have to account for social sentiment. And that is a great transition, one that I'm really happy with because it does take power away from institutions. So I'm happy we don't go back to that market, because what I used to say is like all of this dependence on alternative data for institutions has actually created a vulnerability that Prospero hopes to increasingly capitalize on, with our strategy. Because, when you look at the old way, when I first worked on Wall Street, when I was at a buy side hedge fund, when I was like, this was when I was a real analyst, not really trading anymore. It was the summer of my junior year of college. And back then, so this was what, like that was like 20 years ago. And back then, you know, people used to call up their friends. They would get stock tips on Wall Street. Like, look at this, like blah, blah, blah. You need to pay attention to this stock. Like that was social sentiment amongst Wall Street. Like back in the day, nobody cared what retail thought. But the fact that they do now care, the fact that they do buy things like real credit card sites, camera data, satellite images, web traffic, like all that stuff means people matter more because they depend on people's data. So that is a great change for as far as I'm concerned, because when Wall Street had their druthers and they had their like phone call systems, then basically, yeah, we couldn't penetrate that fortress. But now with this change, like it did open up a vulnerability that Prospero is trying to capitalize on. So I'm very happy with that transition, and it's the right direct. We're just getting started in terms of the direction and how much that could benefit retail investors. And you know, Prospero, I think, is going to keep showing that we can get further down that list. Wolf, if you want to give me specific uranium stocks that you're interested in, I can just Google that quickly. I could just like go through them live. I know some. Oh, Cameco is one that I've looked at in the past that I think top 3 uranium stocks. I'm going to look it up and I'll let you know what I think live. All right, DNN is one that came up. Yeah, CCJ. Those are the ones that I'm most familiar with. DNN, CCJ, and I think there's another one here. UEC. All right, I'm just going to go through those live, and you can tell me if there's other ones, and I will tell you what. CCL. I will tell you what I think in the order of that thing that I just looked up. Okay, UAC. UAC. Oh, we don't have UAC. We'll have to try to add that. All right, CCJ. CCJ is looking good. A little bit lower in net option sentiment than I would like at 57, but 66 upside breakout, 11 downside breakout, 76 growth, and 48 profitability. That's all pretty good. If you have a larger portfolio, I think that's a nice buy. Like in a larger portfolio, it's not my favorite, but I think we have DNN too. DNN not as good as CCJ. Higher net option sentiment, but it's got a 37 profitability, 27 growth. Higher, yeah, it's higher net option sentiment. Yeah, I would definitely like CCJ over DNN. All right. Anything else? Or is that all for today? All right. We're going to do a, well, it's 12:02. We can wind down here. All right. Well, thanks everyone for coming. Another great live stream. Remember, you can, if you want to drop your email here, we actually have a calendar invite that we've started to send out for these meetings. I don't know if that's how a lot of you found it, but if you want, we have it for 2 of ours, and we'll start to distribute that. So
yep, and they don't have
a warning and a direct link.
They don't have to wait a full week to see us. We'll be back Wednesday.
Yep, I'm loving this new schedule. All right, thanks guys.
See everybody then.
On Wednesday.
See you, George.